Okay, guys, today we are starting the almost fourth session of our wealth management for professionals. So, we already had three sessions in which we have learned something about what is wealth management, what is it, how it is linked to, religion, and then what are the factors, who is the villain, and then definitions about wealth, religion versus religiosity. Then we had about who the rich are in the world, then the social composition of the rich in India, who owns the companies. Then we had a case study of Jews, then common characteristics of rich people. Then we had certain case studies, what mistakes we do, and then the perils of being a high net worth individual in India. Then we have busted the four myths related to gold, real estate, then GDP versus uh, stock market, then debt mutual fund. Then we discussed about some, what drives the market, and a little bit about what are there in the so-called, how do India borrow, and what are the major global markets in the world. Then risk and return. Then we try to understand with the help of this diagram, which explains what are the kind of asset classes and how risky and returns they tend to give. Then we had a kind of a graph of last 32 years in which various asset classes have given different kind of wealth which they generated, and then later into the Sensex, and then how it performed over last almost 43 years. Then we try to discuss something related to the risks for this particular year. Then what are the facts of stock markets, and then the composition of each Sensex, Sensex, what are the stocks which were there since 1998 till today, and how each each uh, each of this decade has, there is a churn in the kind of companies within that particular Sensex. Then we had discussed something about who are the stockbrokers in India, Edelweiss, and then the investment philosophies of legends like Warren Buffett, Peter Lynch, Benjamin Franklin. Then we discussed something about what are the main stages in the bubble, how we as an investor gets trapped into the so-called bubble in which we lose a lot of our investment. This is all about psychology. Then comes the different kind of philosophies we generally adapt, like market timers, then future growth and potential. Based on that, you have two kind of investing. One is momentum traders, or the so-called people who generally go for technical analysis, and then there are people who go by fundamentals, how good the company is, by going into the details of their balance sheet, accounting statements, then the philosophy, and then the whatever is there in the annual statement. And also they do a lot of research regarding the industry analysis and the company analysis. And then finally we have discussed about what drives the company at each stages of the cycle. So yes, we end what we have already covered till date. And now coming to today's session, it would be quite interesting because uh, this will set the the entire forum moving. And investment without understanding or trying to discuss about the pioneers or the so-called most successful people in investing, there is no point discussing any kind of subject. When it comes to investments, it is A great legend is there with regarding whom we will be almost interacting for next 1 hour 50 minutes, or rather 1 hour 40 minutes, and later we'll have 10-15 minutes of gap. Huh? Go and check in my pocket cookie. So now if you go through the slide, there is a very interesting slide. Like you just imagine yourself what you are some 15 years ago, when you are at the age of 15, what you would be doing. So any guesses? So this is what we were doing in those days. Do you agree with it? Enjoying with our friends, playing, right? So let's go to the next. So now I'll be giving you an interesting insight about some kids, one person who owned several pinball machines in 3 barber shops, and he owned listed company shares, and also owned 40 acres of land, and he was renting it to a farmer. Can you guess who this person may be? Any idea? Anyway, it's already there in the group. I have already written. Yes, Hota. Can you guess who is that person? A kid of 15-year-old, Javed Habib. Very good. Any other guesses? होता जी म्यूट करिए, म्यूट में रखिए होने के बाद. कुशल. Yeah, Kushal, what's your idea? Horo? No idea. Yeah, it's none other than Warren Buffett. So now today's discussion is all about Warren Buffett, what he is, what is his investment philosophy, and how who are those people who have influenced his investment decisions, and the way he looked into investments, and who are those people who have influenced him. In any case, see, before understanding anything, it's always better and good to go through the kind of journey they went into. So that journey will give you a lot of cues and understanding what they were in the past, how they were molded, and each experience they have changed themselves, and finally they emerge quite successful. And welcome, guys. Welcome to this session. He is none other than Warren Buffett. He was born in 1930 in Nebraska, in a small town called as Omaha. And he was basically, he's from a business family. His grandfather owned the first, you can say, grocery store in entire of Nebraska state in United States of America. Then his father was a stockbroker. Initially, he was a banker, and they were very badly affected due to the so-called Great Depression. And due to that, they lost it, and that the bad influence of the so-called Great Depression has had indelible impact on Warren Buffett, which guided him in future, and he has decided to be rich so that he can come out of the crisis, if there is any such kind of crisis which he had. And he is basically an American business magnate, investor, and also a philanthropist. And he happened to be donated the highest ever so-called charity donation. He gave it to Bill Gates Foundation. So he is named as the wealthiest person in the world in 2008, and currently he is ninth richest in the world. and he always, since last 20 to 30 years, he always had been in the top 10 richest persons in the world, and his only source of income is investment, nothing else. So in 2012, he was named as one of the most influential person in the world. And now we will go to the next. So before we start any further, we just need to understand one, hypothesis, which is quite prevalent. You all might have heard, not only in these markets, and also, during your conversation with many friends, or while watching a TV, especially the so-called channels related to investment and stock markets. You might have heard something called as an efficient market hypothesis. According to this hypothesis, it all believes that market discounts every kind of information. Like, see, the hypothesis is based on the assumption that there is a combined effort of millions of intelligent, highly motivated, well informed, and well educated, and also not only that, knowledgeable and smart investors who have access to information. The moment information is available within the market, that will discount the entire of information, and the prices, market prices of any company will be a reflection of such kind of information. So the final thing is, like, the underlying principle is, you can't beat the market, come whatever it may be, howsoever intelligent, howsoever brilliant it may be, you can't beat it. So this is what. And also you might have heard, like, markets can assume, and already they might have discounted the future cash flows already into pumped into the about a particular company. So this is what you frequently listen to. So basically, yes, whatever the exceptions, they all say that if you tend to beat the market, it is only a random and ephemeral. Ephemeral means it's temporary. It's not at all like, it's, you can't consistently beat it. So there was also a saying that if you make chimpanzees, if you make it or teach it how to type, so one of the chimpanzee may type the entire of the Bible. So this is what is the concept which were prevalent, and they always say you can't beat the market. But this was proven wrong by Warren Buffett. Consistently, he outperformed the market by, initially it was around 22 percentage difference between the market and Warren Buffett's portfolio. Right now it is around 10 to 15 percentage. He always consistently beat the market. Yes, there will always be rough patches here and there, but overall he could defeat the market. So some of those outliers, apart from Warren Buffett, who consistently could beat the market, are Ben Graham, his guru, Benjamin Graham, who has propounded, or rather, he gave a concept called as intrinsic value of share, and also the author of Intelligent Investor, which happened to be the Bible for all the investors throughout the world. And then there is another guy called as Peter Lynch, who happened to be a very famous wealth manager. Then Druckenmiller, George Soros, which you all know about him. Then there is another person by name Julian Robertson. What is the common character between all these players is, they are so smart, so intelligent. They had certain investing principles which they understand very well compared to others. All, you need to know your enemy first before you have to had any kind of a strategies. So in this, you are trying to beat the market. Market is your opponent. So you have to understand the psychology behind it, and understand how it behaves, how it moves. And you also should know what will work, what will not work. And what is more important is what will not work. And that do not come just like that. It comes one with your experience. And also there is a saying, history repeats itself because we don't learn from history. So many a times because we tend not to learn from history, because our assumptions are many a times they are not correct. So these are the reasons why the so-called we can't beat the market. So now with this concept we will move ahead to the next slide. And as on April 2024, he had a net worth of 139 billions, making him the ninth richest in the world. And anyway, we have already discussed about he being a businessman, investor, philanthropist, and he is right now co-founder and chairman and also CEO of Berkshire Hathaway. Is a company which he owns, and he is a founder as well as a chairman. And right now its shares are trading more than 6 lakh dollars per share. 6 lakh means, you just imagine, 6 lakh into 80. Let us assume to take it, you have to round it off, it is around 80 rupees. $1 is 80 rupees of Indian rupee. So if you multiply 80 into 6 lakh, it will be around 48 crores. So each share of Berkshire Hathaway is worth 48 crore rupees. And then the revenues from that particular company is around 364.5 billion as per the latest 2023 balance sheet. And then net worth today is 570.77 billions. And operating income is 120 billion, whereas net income is 96 billion. That is, net income is the profit, core profit, which they after deducting all the expenses. This is what is left out with the company. And then the total assets they handle is somewhere around 1.0069 trillion. So that's a huge asset base which they are trying to manage and handle. And in case any of you, if you have any kind of a questions, kindly interrupt in between so that I can make it clear or explain you further. So any issues, or should we move ahead? Right. So first thing what it comes is, before we try to understand or go ahead, we try to see how do you describe a person, because that is what is his physical appearance or his mental thought process, or what is his attitudes, behavior. That is what comes to our mind. How do one describe Warren Buffett? This is the first question. Warren Buffett, he is physically unremarkable. He looks often like grandfather. He is, he is not the so-called the person whom you see, the smart kind of businessman with the perfect body and then all that stuff. He is on heavier side, and then he doesn't look as smart as otherwise. People tend to understand. They perceive him. And then intellectually he is considered to be a genius, yet he had a down to earth relationship with people, and is truly uncomplicated. He is very straightforward. He is very simple, very straightforward, and very honest. And many a times, people may not like that kind of qualities, especially in countries like India. So that is what he is, and he generally display combination of dry wit, sophisticated, at the same time rustic kind of a humor. So the so-called desi kind of humor, that is American desi. Then he had a reverence for everything logical, and he hate people who behave foolish, right? So he generally dislike foolishness, and he embraces everything simple and try to avoid anything which is complicated. This is how you describe Warren Buffett. Then what are the recipe for his success? He's super smart. he know how to exactly look into each and every situation, and he's so smart that he can take decisions in a fraction of second, and he doesn't take much time. And then second very important thing is he is guided by an overarching philosophy, which we will be discussing. He has 12 principles which he always follow while making any kind of investment decision. So he had a philosophy, he doesn't deviate from it, and come what may, and he is not easily distracted or attracted to something other than his own philosophy which he had. And then he is quite flexible mentally, like he is willing to accept certain things. He is so straightforward that he admit even in his shareholders uh, letter to shareholders, he admits whenever he is at fault. And and also he is quite flexible in accepting others point of view, whichever is in favor of him, and he tried to take those kind of things in his favor, and finally ensure that whatever his bottom line and top line are ensured. Then second thing is he is not very emotional. He don't get carried away by any kind of sentimentality. And this is one of the most character of all very smart and intelligent investors. And because the entire stock market is sentiment driven, there are two sentiments which totally drive the entire of the market. First sentiment is the greed, second is fear. These are the two that wreak havoc in the entire of the system. And then he is usually a contrarian. He take a contrary view of what market is. He always says, when the people are greedy, you have to fear. When people are fearful, that is the time when you have to become greedy. So he goes against the sentiments of the market, and that's where he could accumulate huge amount of wealth, and that is one of the major reason for his success. And he is iconoclastic. And then his views are counter cyclical. Cyclical are usually the stock markets or even the businesses go in a sinusoidal fashion, or the sine wave, in which there will be troughs, there will be peaks, and this cycle will keep on continuing. And he don't like these cycles affect his business and the prospect of his business. So he always tend to prefer those shares which are counter cyclical. And then the second thing is he always had a very long term focus. And he gave a very famous quote. If somebody asks what is the time he will hold a great company, he says it is forever. So you need to understand his focus is not 5 year, 10 year, 20 year. It is to hold it forever. Whenever he finds any kind of great share which is attractively priced, then he is totally unconcerned by volatility. In the At the end of this entire series of lectures, you tend to I'll tend to tell you what matters, what don't. In fact, it is the volatility that keeps you, as an investor, to increase your blood pressure. And also you tend to take many hasty decisions, because you tend not to understand the market. And volatility, generally, yes, everything is volatile because prices are volatile, they keep going up and down. So in such a kind of situation, one wrong decision may totally wipe out all your wealth. So better be very mindful about it. Then second thing is he's totally not at all unafraid of betting big and best ideas. So he is even ready to sacrifice his job, and in any case he need not worry, because he is you can say majority shareholder in his own company. So no one dares to take him out of his job. But finally, yeah, there are so many companies which are owned by a single promoter, but yet they have their own sort of a fear. Then many a times he is willing to be inactive. it's not that every time whatever the idea you get, you tend to be, performing every time in the markets. Yes, Venkatesh. Yeah. Anything you would like to say, Venkatesh? Okay. So, yes, unmute and ask me the question. Venkatesh, unmute. Venkatesh, you want to ask something? Okay. So, this is the secret recipe of his success. Now, let us start. Who are the influentials? Because, howsoever brilliant you may be, and howsoever genius you are, you need certain people who will influence you, who will guide you or inspire you. So, who those influencers are when it comes to Benjamin Graham is? Graham is considered. It is one of the main person is Benjamin Graham. He is one of the four influencers in the life of Warren Buffett. And Benjamin Graham happened to be his guru also. He studied under him in uh, Columbia University, New York. So Graham is considered to be the dean of financial analysis. Prior to him, there is no subject called as financial analysis or securities analysis. And it was he who, through his most celebrated works, The Intelligent Investor and Security Analysis, he has created something called as financial analysis for all investors to understand how to, select a particular company or a script which will generate a huge amount of returns. So that is successfully discussed in these two works. And to start with, he started his career on the Wall Street as a messenger at the brokerage firm called as Neuberger, Henderson and Loeb. And then he used to post bond and stock prices on the blackboard. Today, if you see, all the prices are given, you get it on the computer screen. In those days, it was not like that. It used to be displayed on the board. So he was one of the messenger who used to write in the New York Stock Exchange, and he used to work for $12 a week. And then from 1928 to 1956, with the same company, with another company, he had a partnership with Newman. So that Graham Newman partnership that went on for 28 years. And during that phase, he used to teach night courses in finance at University of Columbia. So this is the time when the so-called Warren Buffett could, interact with him and become his disciple or a student in the classrooms. And next is the essence of security analysis, according to him, is based on the well chosen diversified portfolio of common stocks, and it should be based on one, reasonable prices and a sound investment. Usually portfolio, we tend to say a diversified portfolio. Why? Each of the company and the industry is subject to so much of uh, risks or something called as unsystemic risk and systemic risk. Systemic risk is something which is affecting the entire market, whereas unsystemic risk is affecting only a particular industry or a particular stock. So you this what the portfolio theory teach you is, in order to neutralize or reduce the unsystemic risk, you have to have a diversified portfolio having different beta, different risk. They are they move in opposite direction. Suppose pharma may not do well when the market is doing well, and then say IT is moving along with the market, so they both are negatively correlated, and they make a perfect diversified portfolio. So that is how you need to build your own portfolio. Then what he says is a true investment, it should have two qualities. What are those two qualities? Quality number one is that some degree of safety of principle to ensure that whatever you have invested is not lost and you get back whatever you have invested. Second is a satisfactory return on the rate of return. Say you have invested 100 rupees and say you have invested into a stock which is giving you some decent returns like 10 percentage, which is 3 percentage above your so-called bank interest rate. It is said to be a safe, satisfactory rate of return. Then next is what is the most important factor in determining a company's value? He says, according to him, it is the future earnings capacity of a company, and that is based on a certain formula which is being propounded in the next slides. I'll be discussing about John Williams. So that fellow has propounded that dividend income theory, and based on that, uh, most of the calculations, the so-called discounted cash flow statement, all that stuff is propounded by him. That will come at the later stage. That can calculate your future earnings of a particular company. Then he told something about intrinsic value, very quite interesting. So he says that what you pay is a price, but what you get in return is the value. Say if you pay a cheaper price for a very valuable company, that means you are in a very right kind of a investment, because even if things go bad, your investment will be quite safe. You don't lose much money. And if it is opposite, say the value is low but the price is very high, this is called as overvalued stock. When you invest into overvalued stock, it is bound to correct and you are going to lose money. So you have to be very very careful while dealing with such kind of thing. So the next thing is what he was saying is the intrinsic value is found by estimating the earnings of a company and multiplying the earnings by an appropriate capitalization factor. That capitalization factor is known as discount rate. And initially there was no literature about what forms this capitalization factor. But initial stages of the research, they found that the capitalization factor, or the so-called discount factor, should be usually 10-year US government bond. So that is how the treasury bond, which is said to be the risk-free rate of return, that used to be the capitalization factor. However, after the development of CAPM model, then they understood why should an investor invest if he had to get only the same rate of return which is given by a bond. So he expects something called as a market premium. Unless there is a premium, why would he invest? So there is no point in investment. So later, after CAPM's development, that theory's development, that factor got changed. So the company's stability of earnings, assets, dividend policy and financial health definitely influence the capitalization factor, or the so-called multiplier. So that is the factor which we take into consideration depending on how risky is the business or the company. So more the risky the company, the PV factor or the multiplier factor or capitalization factor will be much higher. The lesser volatile it is, the lower it is. Then it is he who propounded two rules, which is, you can say, this is these two rules are made quite popular by Warren Buffett. He says rule number one, you don't lose your money. And rule number two, he says that you don't forget the rule number one. That means you should never lose your money when you are investing. So this is the basic crux of Benjamin Graham's philosophy. Then the second influencer It is Philip Fisher. Initially, the so-called Warren Buffett was very much influenced by his guru Benjamin Graham, and he worked for 3 years from 1953 to 1956 with Benjamin Graham. And that was a time when he had a profound influence and he understood the nitty-gritties, how to calculate the intrinsic value, how to pick the stock, what are the stocks to avoid, why it should be avoided, all that stuff. However, what he understood from the interaction with his boss or guru is that, see, he is very much into, something called as cold data, or data on whatever there in the balance sheet or the so-called accounting statement, or in the in the shareholders report, or the so-called directors report given to all shareholders. He never used to go beyond it. But Benjamin Graham was of the firm belief that yes, apart from that, you have to look into consideration the quality of management, because they are the people who drive a particular company towards whatever the profitability, or the losses, or they can either destroy wealth or they can create wealth. Hence, he is of a very firm belief that yes, it is the quality of the management that determine whether you have to go for a particular X company or Y company. So, keeping this into background, this Philip Fisher is the person. He influenced the entire investing community into his own theory, which we will be discussing very shortly. And it is Phil Fisher who said something about, he called it as, his technique called as scuttlebutt, that we will discuss a little in detail at the later stage. Now, about him, he also worked as an analyst in Anglo London and Paris National Bank in San Francisco. He was also a victim of the so-called you can say the Great Depression. All the four people whom I'll be discussing are all people who are victims of the Great Discussion, the Great Depression, which also includes our Warren Buffett. So they're all badly affected. That is the reason why that has prompted these four gentlemen to come up with a very solid principles of investing, how not to lose wealth. And then now, if we see, after a brief and unproductive career with a local brokerage house, Fisher, he decided to set up his own investment counseling firm. On 1st of March 1931, Fisher and Company got started soliciting its claims, and this Great Depression has given him the time to interact with a lot of investors, and that is the time when he understood why stocks stock market went bust during that particular period, and what are the reasons behind the failure of stocks. So with that understanding and with that experience, he came up with a certain principles. He came to believe that the people could make superior profits by, one, investing in companies with above average potential. You always have to understand, and this is one of the very very important theory which is given by Philip Fisher. I think you all have to take it like a textbook, because he had profoundly influenced Warren Buffett than anybody else. So you also have to look forward to this particular his theories and his principles. And if you see all those 12 principles which Warren Buffett follow, mostly they're all influenced by Philip Fisher. So number one, what he says is investing into a company which are above average potential. Above average means those companies which are performing uh, better than a little, or better than the average in that particular industry. Say in an industry, say some automobile industry, the average growth rate over last 10 or 20 years is say 10 percentage. So any company which is growing beyond 10% is said to be average, above average performing company. And then second is they are aligning themselves with the most capable, uh, management. So what is more important is how do you pick stocks? First is you need to see whether they are above average compared to the industry. Then the second thing is whether they are managed by most capable and talented management. And then what kind of talent and all we will discuss a little further. And then what he says is that companies with above average potential, uh, it is like companies ability to grow sales over years at rates greater than the industry average. As we have I discussed with that example of automobile sector, like if that sector is growing, say compounded since last 20 years 10% on an average, and any you have to pick up any company which is performing better than 10 percentage. If it is less than 10 percentage, better discard, don't choose such kind of a company. And then that the growth was combination of two factors. What are those two factors? One is the commitment towards R&D, and second is very effective sales organization. See, you may produce an excellent product, but if your sales team is quite bad, then the company cannot sustain in the long run. And the opposite also, you have an excellent sales organization, but your product is not up to the mark. Naturally in the long run you will not that company cannot sustain for a very longer period of time. So hence what is more important is it has to have both R&D and D and also effective sales organization. Then what is another important is that the company can develop any kind of outstanding products or services, but unless they have expertise in how to package it and sell it, it will not be worth. And they will never, it will not translate one into revenues, two also into healthy profits. In order for any company to sustain, it requires healthy profits. Without healthy profit, it will not sustain in the long run. So then next is like what are those what drives a company into profitability. What he says is first and foremost he says it is the cost information, whether it is direct cost, indirect cost, or whatever. All the costs are the things which drive a particular product, or and the pricing is totally dependent on the cost. And second, what he says is about accounting controls. And we all might have heard about so many accounting frauds, be it Satyam in India or Cox and Kings, Amtech. Then you are, you know, recently there are certain issues with IIFL. Then you are all these companies, they're all uh, due to slack accounting controls. And globally, companies like World.com or Enron, all these companies gone bust. And they're all gone bust because they don't have something called as a proper accounting controls. And when the accounting controls are not proper, naturally the reporting itself will be totally malified, and it will never give a true picture of the financial health of that particular organization. So if you don't get a proper information and you are not in a position to judge the financial health of any company, then it is a sure shot recipe for failure. So that is how it fails. What he says is these snags, when you are going through the accounting statement and the accounting controls of the company, then you find certain snags or inefficiencies. These are the things which give you a warning. So what are those kind of snags? Usually it is the so-called, the most important is related party transactions. And most companies, whichever have failed in the world, they all fall into a category where there were so many related party transactions which are either not properly disclosed or they were not at all disclosed. And whenever there is a related party transaction, the accounting principle says that it has to be at an arm's length deal. Like whenever you are going for such kind of a transaction, assume that you are nowhere related. What is the price you pay for it? So if that is a fair as per the fair market value, then it is said to be at arm's length deal. Otherwise, if it is in favor of the related party, then it is not said to be a, a kind of a healthy kind of a thing. So that is a sure shot, is a recipe for a disaster. And then this is one. Number two is, whenever you try to uh, or the controls are so weak that it could not detect any fraudulent payment. One is payments. Second is your controls are so weak that your whatever the claims from your debtors, sundry debtors, if you could not churn it within say a less amount of time, and the turnover is so high, then naturally it will also lead to uh, you know problems in your cash flow statement, whereby you have to, in order to ensure that your working capital is smooth, you will naturally spend huge amount of money and you will generally waste it. And second, and the rest is like creditors. There is a principle which usually the so-called corporates follow is, they tend to, whenever it is any receivables, they try to receive it much ahead, whereas whenever there is any payable, they try to delay the payment. So this is how efficiently they try to manage the cash flow. So if it is a vice versa, reverse of what I said, naturally company has some issues. Then apart from these things, then what kind of a model do they have? What kind of sales? Whether the sale is a cash sale or is it a credit sale? The companies which have high amount of credit sales, they show something like, a lot of sales growth will be seen, it will be visible. However, not all the sales will translate into the so-called cash. If you don't get cash, that may turn into a bad debt, whereby your company may lose the amount which you have paid to them. So that is the risk which, usually these accounting kind of a thing, which I illustrated few of them. There are so many which, because of paucity of time, we cannot discuss any further, but I just gave you some examples. So what these snags will give you a early warning about the company's performance. So based on the company's performance, you have to gauge whether there's such kind of any company whichever have such kind of snags, you just have to avoid. And any company which has excellent accounting controls, they are the ones you should anytime look into. For that, you need to do a little bit of research. Yes, it takes time, but yeah, if you want to be successful as an investor, you should do it. Then, second, next is the Fisher is also aware that superior companies not only have above average business characteristics, like they are into such a solid business, and they are into an industry which is in a growing segment and not either in a declining or, or some stagnant stage. And they know that yes, the potential is high. They have had something called as a uh, sustained competitive advantage. So if they don't have this competitive advantage on a over a long run, naturally they cannot sustain for a very long period of time. So this is one. And also they are one more thing which is very important, apart from, being in a better business. The second thing is like the management should have above average managerial capability, whereby they can churn good amount of business with ensuring that the top line and bottom line is totally taken care of. Top line is nothing but revenues, bottom line is nothing but profits, and both are growing at a very decent pace. It may not be exceptionally high, but yes, it is above market. Then Fisher considered another trait critical. This is very important. Does the business have a management of unquestionable integrity and honesty? So, what the central theme of this Philip Fisher's theory is that you need to have a management whose integrity is beyond doubt, and second thing is they are dead honest. And if you don't have this, and also one more thing, they should be highly capable, also intelligent. If either of these things are compromised, naturally the company will definitely see its decline or demise. If they are there with those things, those people, naturally company will thrive, and the companies are in the safe hands, which will ensure that the investors wealth is protected. So the next question is, do the share managers behave if they are trustees for the shareholders, or does it appear they are concerned with their own well-being? There is a very, I think we will in future to come, we will cover these two aspects in greater detail, which is called as the manager and owner, the so-called conflict. The shareholders and managers conflict is one of the most significant conflicts in this particular industry. And then many a times these conflict need to lead to poor performance of companies, and despite poor performance and disasters by these managers, they take home with a very fat paychecks. So these are the two things which one need to take into consideration before jumping into or finally selecting a particular stock. And then the next one is, one way to determine intention is what he says very important. We all have to take note of it. Is that how do they communicate with the shareholders? See, usually what happens is all the businesses go through good days as well as bad phases. During the good phase, general observation, general experience, and general psychology of the people is that they tend to be, more open. They tend to be more honest with whatever are happening, because it's not negative to them, or to the to one is to themselves and also to the company. So what matters is how do they behave during the difficult times. During difficult times, are they trying to hide information? Are they trying to project something much optimistic than what exactly the market is? And another very important aspect is, are they honest? Are they trying to hide anything? Are they accepting their own mistakes? See, it's all human that we all are prone to our own biases, and most of the decisions we take, they're all based on certain biases crept inside us and with certain assumptions. And nobody has seen future, and not that everybody in the world is perfect. No one is perfect. So when world is imperfect, naturally decisions also will not be perfect. So natural outcome is like, yes, whatever it may be, the manager should be quite honest in accepting mistakes they have committed, and also to, it is their duty to ensure that they inform everybody about whatever is happening in the company, whether it is good, bad, or the kind of a decision, the logic they have taken, and how did they arrive at a particular conclusion. All those things should be quite open, and this you find in Warren Buffett's statements. Whenever he interact or writes to his shareholders, you tend to get all these ingredients which, and they are, pleasure to read. In fact, I didn't read, I was just going through these books, the so called Robert Roberts, the book called The Warren Buffett Way. That was excellent book. It has given a lot of details in about this entire, Warren Buffett, and he himself was an analyst, stock analyst. Later he wrote a book about uh, the Warren Buffett. Till date, Warren Buffett did not write even a single book about his entire secret recipes. And this is one of the most authentic book I have seen, and I have gone through that. And I will just maybe shortly I'll forward this in our group also. If they read it, it would be better. Like you will gain a lot of insights into how these successful people like Warren Buffett could churn huge amount of wealth just by investing into stocks. So the next is one way to that's over. I think now another thing which is very important is employees should genuinely feel that their company is the best place to work, and especially it all matters about how the blue collar employees within that particular company are treated. If they are treated with respect and dignity and decency, that means the company is very good, very decent. If the blue collar employees are ill treated, they are being exploited, they are being not given the dignity which they deserve, then naturally that company is sure shot recipe for a disaster. And executive employees should feel that promotion is also based on ability, not favoritism. We tend to hear a lot of stories, especially in Indian corporate sector, whereby you find the things are not transparent. Then the promotion policy is not based on the ability. A lot of favoritism in terms of so many things. Biases crept in within the management. It may be based on caste, or it may be religion, or even gender, or quid pro quo. All these kind of things. So this is one of the criteria, very important criteria before you take up any company. So you have to see whether the employees feel it is a great company to work or not. This is one of the criteria you have to identify, and take your decision based on this. Then the next thing is Fisher also considered the depth of management. Depth in the sense, does executive officer have a talented team? All the leadership, all the companies are all totally dependent on manpower. Higher the better the quality of manpower, naturally the entire of the thing will be better. The quality of team matters a lot, and with a weak team you cannot run a great businesses. And there is a quote which I would like to say, like, see, it is always better to have a lion leading sheep than a sheep leading a group of lions. So, what is more important is the leader should be highly talented and capable so that he could lead the entire team towards victory. So, that all depends on how talented the team is, and the more the talent, naturally, the better will be the performance of the company. And second aspect is CEO able to delegate authority to run parts of his business? And in this, what is more important is how centralized is the decision making, or how decentralized. Whether they are following theory X or theory Y. There are two theories, theory X and theory Y. Theory X is authoritarian, right? The top leadership feels that the uh, you know uh, people below them or the so-called subordinate staff, they are incapable, they don't have any sense of responsibility, they are quite lazy, and they are to be regularly, uh, corrected rather than, counseled. It's corrected. They are being punished whenever they are at fault, and then all the managerial decisions are taken by one single person. And then the other is theory y. What theory y says is that yes, everybody is capable enough, they are all matured enough, they have cognitive abilities to think about situations, circumstances, and based on such circumstance and situation, they take appropriate decisions. So this is a theory y. So theory y is more about collaboration, collaborative and decentralized decision making, so that in the long run will help a company to grow better. And the problem with the theory x is, like, the moment the leader is out, there will be a huge power vacuum. And since the subordinates are not used to taking independent decisions, such kind of a companies are bound to fail, because there will be a leadership crisis, and also they are not used to taking such decisions. And then Philip Fisher propounded a very important thing which he called it as scuttlebutt. It is basically a catch-all inquiry. It's like, what he says is, you as an investor, you have to have a very sound research. You have to make a sound research whereby you interact with the management, with the employees, their vendors, their end users, and you have to have all, interaction with all the stakeholders. It is definitely time taking, it takes a lot of time and efforts, and many a times you may not get appropriate, information from the so-called all the whosoever the stakeholders of a company are. So to ensure that all these stakeholders, whatever they speak, what you need to do is, you have to have an excellent decision making capability whereby you can identify what is a truth from. See, there are two kind of things usually people say, that is, one is objectivity and the subjectivity. Objective is based on facts, and they don't change much. The second thing, when the subjective part comes into account, you have to see how subjective is it. Is there any logic behind subjectivity? Because after all, we are all human beings. We all have our own viewpoints. We have all our own opinions. So opinion is per se is not wrong. Opinion, if they are not backed by a proper logic, proper reasoning, proper fact, or proper principles, that is inappropriate. So you as an investor, if at all you happen to have a kind of an inquiry, you have to look into these matters, whether that particular whatever the information you are gathering is objective or subjective. How subjective, in when it comes to subjective information, you have to see how far that is logical, that is fact based or logical. That in any case, with a little bit of understanding, you tend to identify it. So this is all about scuttlebutt. And then what he says is, because you have to do scuttlebutt, you have you don't have much time to do a lot of research on many companies. Rather than holding so many companies, instead of that, you focus on few companies, say some 10, or even out of that also. In his portfolio, especially of Philip Fisher, there are only 3 or 4 companies that represent 75% of his entire equity portfolio. So it will be highly skewed depending on what is his perception, and how much you are anticipating growth in terms of your the so-called uh, enrichment in terms of increase in your wealth. Wealth can increase in either two ways, either through incomes like dividend and all that, and the other is the price appreciation. Many a times many companies like a company like Warren Buffett's Berkshire Hathaway, they have they haven't given any dividend since 1967. Just imagine. And there are companies which pay you dividends continuously on a consistent basis. So a dividend paying company need not necessarily be good or bad, the vice versa. So you have to be very clear about the kind of companies, and don't make your decision making just by the dividend policy of a company. So you have to ensure this particular thing. Then comes is a very important thing, which is the core philosophy of Warren Buffett also. Like, you only invest in the companies which were within your area circle of competence. We all developed competence either by way of education or by way of experience in a particular segment or sector or industry or a company. So we develop certain competence, and that is the that is said to be circle of competence. Suppose an IT graduate is there who is working in a software company, and his area of competence will be naturally everything related to information technology, computer technology, and all the spin-off technologies related to it, like maybe artificial intelligence, blockchain technology, cloud computing, etc., etc. Suppose we are into, say, an organization like I am from Indian Railways. So my core competency being into finance is one, finance, then railway. And I'll be having a better understanding about the vendors of railways and railway ticketing, railway PSU. So all that we have, we should, that is called my core area of competence. So what he says is, the Philip Fisher says is, you should not go beyond circle of competence. And based on his experience, he felt that many of his investment went bad because he has gone beyond his circle of competence. The day, the moment he choose companies based on, say, something like, grapevine, or based on somebody suggesting, or by listening to the so-called TV television channels, or some other analysts and all. So you never get influenced by somebody else. You have to be influenced by within yourself. You should know what is your zone of, or the circle of competence, and what are the segments, companies which you are very comfortable. If any company is there, however great the company may be, don't invest into it because it is not within your circle of competence. So keep this particular thing very clear, and then I wish you all understand this particular aspect. And the next influencer is John Burr Williams. He is also a person who lived through the so-called era of Great Depression. He is a graduate from Harvard University in 1923, and then that is the time when he developed taste for economic forecasting and security analysis. So he briefly worked as a security analyst for two well-known Wall Street firms, and then later in 1920s and a disastrous crash of 1929 and its aftermath, the experience convinced him that to be a good investor, one needs to be a good economist. So, because investment and economics go hand in hand, and whenever the company, economics are going bad, that means you can expect a bad performance by the companies. And this particular urge, or rather realization, made him to earn an advanced degree in economics from Harvard University. And frequently I used to quote Scumpeter. Scumpeter happened to be one of his, guide while he was doing a research. He submitted a research paper called as intrinsic value of a common stock. So that before publishing this particular, paper, he has sent it for publication. Initially, he was rejected. Later, Harvard itself have agreed to publish it with a condition that he has to take care of printing costs. So he is a very important person. He has propounded a theory which is commonly called as dividend discount model. Even till date, this is the model which is used to value a stock or a bond. So then the theory of investment value which he has published is basically a great classic. Based on that, it led to similar such theories in the future by future economists like Fama, Harry Markowitz, Modigliani, and Warren Buffett calls this particular book as most valuable book and genuine classic. And his entire, if you see how he values a company, the intrinsic value is based on the theory propounded by Williams. So it would be interesting if you learn how that, what is that model and all. Later we can, I think maybe in future to come, I'll take up this session also, how to value a stock and bond. That will come uh, quite later. And then the fourth most, you can say, influencer in the life of Warren Buffett is his own partner, Charlie Munger or Munger, however you call it. So Warren Buffett and Charlie Munger happen to be from the same place, and both have worked in the grocery store of Warren Buffett's grandfather. However, Charlie Munger is few years elder to Warren Buffett, and they started having partnership from 1956. So they had so many acquaintances in Omaha. There were many common friends who know both of them. But however, they met for the first time only in 1959. And Munger basically is a son of a lawyer and grandson of a federal judge. And he initially did his law, and he had a law practice in Los Angeles area, but he had a very strong interest towards stock market, and that urge or interest or passion led to him forming an partnership firm in 1962 while he was, doing his regular practice in law. So Munger's investment partnership went on for few years, and it's no different from that of Buffett's. But the core principles behind, their investment style is all the same. Like, intrinsic value of a company, then margin of safety, identifying good companies which are at a cheaper or attractive prices. So this was their basic principles which they adopted. So how he influenced? Actually, it is, Munger, like Buffett, he also bought a company called as Blue Chip Stamps, like uh, Buffett purchasing Berkshire Hathaway. So later, both the companies got merged, and because of merger between both the companies, where this Charlie Munger became vice chairman of that Berkshire Hathaway company, a position he held till his death. And Munger is passionately interested in many areas. like science, history, philosophy, psychology, mathematics, etc. And he is a firm believer that once you have understanding in various areas, that will help you to apply those concepts in your decisions. That includes investment decisions also, and the investment decisions will be much more richer or wiser and better compared to uh, not knowing these subjects. So hence he has influenced the so-called Warren Buffett. Otherwise, Warren Buffett used to go by only the so-called philosophy of his what do you call his guru, Benjamin Graham, and he was totally only focusing on intrinsic value, that company which are cheaply priced. But there was a stage once American markets, stock markets, have gone from the so-called emerging markets to a matured markets. There was so much of plethora of information available within the market, as we have discussed about efficient market hypothesis. The information is available with millions of investors, and that information discounted the value of a particular company. So you can't discover a price beyond what is discovered by the market. And that concept, it is quite often it is very proved to be correct in more than 95% of the cases, or even more, where even if you see the so-called fund managers, whenever you take from any mutual fund, you find that majority of the mutual fund managers fail to perform better than the market because of this efficient hypothesis theory. So when you have conceptual clarity in so many areas, naturally that lead to your decision making, and that has influenced Warren Buffett. And he, being a lawyer advocate, he brought something called as a legal or legal opinion, or the legal due diligence, that help picking up right kind of a stocks, and that has transformed the way Warren Buffett used to pick up the stocks. Especially Munger was very much influential in convincing Warren Buffett to pay 3 times the value for See's Candy. It's a candy company which usually Warren Buffett, otherwise he will not pay more than what the value is, value of a company. He always discount it and pay lesser than its value, so that ensures the so-called safety margin, margin of safety, whereby he don't lose money. But however, that was because of Munger and his influence, he had to purchase, and that happened to be his later day investment style. So these are the four guys who have influenced Warren Buffett in his the way he had uh, looked into investments, and the way he has picked up stocks. So these are the four influencers, and now it is open for uh, questions. If anybody want to ask any question, you are welcome. Anybody? Hindu, Raghavendra Saraswat, Roshan, Ramashrai, Hota, anyone? Yeah, no questions. Raghavendra, you want to ask? Yeah, how are you? Yeah, yeah, of course. Yeah, Yeah. Welcome, welcome. Anybody else? Hindu? Hindu, you would like to ask? Hindu? Okay, Ramashrai? Ramashrai, bye. Okay, then I'll go to the next slides. So it's not done yet. So let us start with the journey of Warren Buffett. Now you have understood one, you have seen who the Warren Buffett is, what is the secret of success or ingredients of success, and then we have seen who have influenced him, who are those four people who have influenced him, and his way of outlook or way of investment. And then now the next one is what the Warren Buffett, what is his journey from, of course I have taken it only till 1969, because after that there is quite a less, nothing much, because he has matured from you know, you can say technical analysis to finally the principles which are propounded by the so-called all these four gentlemen which I have referred to: Benjamin Graham, Philip Fisher, John Williams, and Charlie Munger. Now, from there, we will see what exactly, how, what was his life, and how that life took a turn, what he learned, and what we can learn from his life. This is very important. And then, actually, he was born in August 1930 in a place called as Omaha, which happened to be the largest city in the state called as Nebraska. Nebraska is one of the least populated places in United States of America. Out of that, the largest city is Omaha, which is in Indian parlance, it's just 4 lakhs. The population is just 4 lakhs. But yes, that that state has billionaires like Warren Buffett, Charlie Munger, and few more. So he was basically a middle child and only son of three kids of four-time congressman. His father was a congressman. Initially, he was a banker. He lost job during Great Depression. He was totally frustrated and depressed when he lost job. That is one of the reason why Warren Buffett is very much deeply influenced by, you know, that the crisis which the entire family had. And his grandfather was a businessman. He owns a grocery shop, which is the first in the entire Nebraska. So, and his father, after losing job, he later set up a partnership firm into stock broking. And that stock broking, when he was as a stockbroker, this that was a time when Warren Buffett used to frequently visit his office, and he also used to write, you know, the rates, the quotes of each stock on the board, blackboard. So that is how he was introduced to the world of investment. And then from early age, he had an exceptional aptitude towards numbers. Like, and he always had a desire to make money, as I said, because their family is badly affected by Great Depression. He thought that he had to become very rich, and that influenced his thought process from the quite an early age. And that desire, exceptional aptitude for numbers, made him to think, you know, being ahead of his generation. And at the age of 6, he started earning and he started doing business. What he used to do is he used to purchase a pack of 6 cokes from his own grandfather's grocery store, at the rate of 20 cents, and he used to sell it for 25 cents each bottle to his own friends. So in the beginning itself, he used to earn, at the age of 6 itself, he started earning 25% profit from small business ventures. And then later he was very much, at the age of 7, he started reading a book called as Thousands Ways to Make Money. So he is already wired to be a successful investor. He was avid reader, and also he was uh, his appetite is so voracious that he always wanted to learn more, and he was fond of reading books, and that made him to go through so much of literature and material related to everything related to investments and stock market. And then at 8, he started reading his father's books on stock markets. So that is also one of the guiding factors. And then at the age 11, he started writing on board of his father's brokerage house regarding daily prices of stocks and commodities. So at the age of 11, he picked a stock based on technical analysis. That company is called as City Services Preferred. He took three shares for himself and also for his sisters, same amount, almost the same. And then, you know, uh, immediately after he picking up that stock at $38, the stock got plummeted by, matlab it went down to 27 a share. So his sister started pestering him so much that guy got, totally disturbed. And then later, once the share went up to 40, immediately he sold the share. And then because he thought that, yeah, the more he hold it, the every likelihood that stock price may even fall further. So that was a decision which affected him quite badly. Later, the same stock, within a very limited period of time, it skyrocketed to around 200 shares, 200 per share. Then, being very good at numbers, he calculated that it is his 20 years of worth he lost just because of one foolish decision. That decision made him to realize that in stock market, if you have to reap the benefits, you have to wait, you have to be very patient. You should not lose sight of, and you should not be bothered about the so-called fluctuations within the market tend to be fluctuate, but that should not guide your decision making. So the next is at the age of 14, he, with the help with whatever the amount he earned by doing small and sundry businesses, he invested into 40-acre farm. Just imagine 40 acre, and we, even at this age, we don't own any big chunks of land, and he owned 40 acres of farmland, and with $1,200 at that time, $1,200 in 19, he for 1944, maybe today it may be some crores of rupees. So you just imagine, see the business acumen he had and the appetite for investments. Next is in 1944, that was a year, like at the age of 14, he filed his first income tax return, and he took a very smart move by taking $35 deduction for his bicycle and watch, because he used to, uh, work as a paper boy for 2 or 3 newspapers. So he used to use his cycle to, you can say, distribute the newspapers. So bicycle and his watch are taken as a deduction. And then at the age of 15, what he did is he made more than $175 monthly by just delivering Washington Post. And in 1945, he, along with a friend, actually they have migrated from Omaha, their native place, to Washington D.C. after his father becoming the congressman. So that is the time when he went to even to New York Stock Exchange, also being more nearer. So he had a first glimpse of how the stock exchange looks, the kind of a trading which it goes, and he understood the people, the market, the so-called process, you know. And then that is the time, at the age of 15, he had a tie-up with the three barber shops, putting pinball machines, and that machines he got tremendous amount of money, and within just few months he had many such machines. Finally, he sold it to a war veteran for around $1,200. And with that amount, by the time he finished his college, he had a savings of $9,800, which today means the book was written in 2005. At that time, the value of that amount is $1,25,000, which may roughly translate into say around a crore in Indian currency. So in 1947, when he was 17-year-old, he graduated from a school called as Woodrow Wilson High School in Washington D.C. And being so successful in business, he thought, I should not study any further. Enough is enough. Let me plunge directly into the business. But his father, he did not agree, and he said, "You have to go and study." So finally, he sent him to University of Pennsylvania Wharton School of Business. So basically, during he was his study in Wharton University, he wasn't happy with the the way they were totally focusing only on theory. There is no practicality or the so-called application of the theory part. So he got so fed up and bored. Later, after 2 years, he transferred to the University of Nebraska. And during that period in Nebraska, he happened to have come across the books of the so-called Benjamin Graham, who later happened to be his mentor, his guide, and also his, his, uh, you can say, guru. So that is how he learned even further the tricks of the trade from the so-called technical trading. He now entered into the so-called the intrinsic value, how to find out or how to calculate an intrinsic value of share, and what should be the margin of safety. Usually, it is said that you have to, discount any say intrinsic value of a company is suppose $100. You have to always have one third as a margin of safety, and if the price is below $67 or 67 rupees, you have to purchase it, or else there is no point purchasing below that particular thing. That is the concept of intrinsic value and the so-called margin of safety. So next, what he did is, after completion of his bachelor's degree in 19 at the age of 19, he did bachelor's of science in business administration. He later applied for Harvard. He was being rejected because he didn't complete 21 years, which happened to be the norm in those days. So later, knowing that Graham is teaching in University of Columbia, his you can say guru. So he joined the Columbia University. He finished PG at the age of 21. He did MSc in economics. So during initial years, his investment happened to be mostly into gas station and real estate investments, because that is what he used to see. He thought that these two kind of businesses will make the best investment. However, they were quite unsuccessful. So then he realized that no, this is not the right model, and then he went so bad that He was so financially broke. He had to take night courses in University of Omaha. And however, being highly the so-called uh, introvert, he's an introvert. He had a stage fear, so that public speaking became a big challenge. Then he took a very bold decision to take public speaking classes. And after attending such classes, he learned how to the art of speaking in front of public. So that helped him to financially to support his own family. So despite financial obstacles, he has completed his post graduation, and he was looking for some role from his mentor Ben Graham. Ben Graham had a partnership with another firm. He had a partnership firm. So actually, he applied for him because during that university age, uh, Warren Buffett is the only student in the entire career of Ben Graham or Benjamin Graham awarding A plus. Till date, nobody got it except Warren Buffett. It used to be a kind of a stupendous or excellent kind of a conversation between both of the guys, both geniuses. And it was the class used to be only between Buffett and Graham. So that was the level of involvement in that subject and the interest he has shown. So, but to his bad luck, Ben Graham could not offer him any job because there was a restriction that the jobs are to be offered only to Jews. So he missed the bus. He later left Washington DC or New York. From New York, he has shifted to his own native place, Omaha. That is where he started Graham Partnership. They initially it was around 7 or 8 partnerships he had, and with his own, he could successfully raise a capital of $1,40,000, and with his own investments. Initially, he put only hardly $100, whereas his partners all combined together they could raise somewhere around $1 lakh, and that is how he set up his first company. And a very interesting bargain between his partners and himself. He says he will be offering 6 percentage return every year. Anything above 6 percentage, if there is a profit, 75 percentage will go to the partners and 25 percentage is his. So that is how he became rich because of this partnerships. And he had a particular target. The target is the at the time the index of stock market was Dow Jones. Dow Jones, his target is to beat it by 10 percentage, and he had beaten it by 22 percentage in that 13 years of his initial career, and the money was compounded at the rate of 29.5 percentage, which is if we even otherwise it's like every two year 3 months the money started multiply doubling. That was uh, a tremendous growth he has seen in that initial years. And then later in 1960, it was the first time he has taken from purchasing a stock as a minority stakeholder, he jumped into controlling the businesses. And the first business he tried to control is Dempster Mill Manufacturing Company, which used to produce farm equipment. In 1962, he had the partnership has grown in excess of 7.5 million, out of which 1 million happened to be his own personal stake. As I said, 25% go to him for every profit beyond 6 percentage. So that is how he amassed $1 million, and he became millionaire for the first time in 1962. So later, what he found is what he said is yes, he has totally disbanded all his partnerships and made it into a single entity with a holding company. And he shifted his office from his residence to Kiewit Plaza in Omaha, which is his current office is located in that place. So within a decade, he could generate 1,000 times, or sorry, 1,000 percentage, or so-called 10 times the return. Just imagine, within a decade, 10 times the return is something which you cannot imagine. And in 1965, his partnership assets has grown to 26 millions. And after accumulating 49 percentage of common stock in Berkshire Hathaway in that year, 1965, he has named himself as a director. That is the first time he became a director of a company. Then 2 years later, he almost took the entire controlling stake from a person, Jack Ringwald. See, there was a very interesting conversation that happened between them. That, yeah, somebody is saying something. Someone kindly, Raghavendra ji, kindly, can you put it in mute? Yeah. So, see, there was a conversation between one investor, shareholder who is controlling, some controlling equity by name Jack Ringwald. He asked, "What is the company worth?" Ringwald told, "Yeah, it at least $50 per share, which is actually it is $17 above the trading price of 33." Then Warren Buffett immediately after offered him on the spot, 50,000, 50 per share. He has taken, that has costed him around 1.8.6 million dollars. So he has taken the entire controlling stack. And prior to that, there is a very interesting story. Initially, his concept was called as cigarette butt strategy. It is like the companies which are cheap, like we usually tend to do. Even I did it, but that was a big failure. Which initially, even it was a failure for Warren Buffett also. So what he did is, in the cigarette butt strategy, he identified the companies which are selling, say, at pennies, and they are valued more than the current trading price. And he felt, if he purchase such kind of a companies whose value is higher than the so-called current market price, he would get benefited and enriched. And those companies are those companies which are not performing well. One of them is Berkshire Hathaway. So when he approached the owner, he said, "What is the worth of the company?" Company is worth at the time, the market price is around $7, whereas as per his calculation, the intrinsic value of the firm happened to be 11. So he took a certain stake initially, and then the company owner who had majority stake, he is he is still, at that time he was acting as a manager of the company. So he told, "I'm willing to pay $11 if they that in case of right movement." Raghavendra ji, mute करिए. So later, this manager has fooled him, and then he was asking for $11 instead of 7. So finally, he took, in the fit of rage, he purchased the entire of the stock. He purchased the stake, and then he fired him. That is how he owned Berkshire Hathaway. That company happened to be into textiles, and it is in mostly into the so-called uh, northeast Atlantic seaboard of United States of America, near to New York. So they had many textile mills, Whereas there was something, the textile business has become less remunerative or unattractive due to globalization and competition from cheaper textile products from especially from the developing countries. So initially, Warren Buffett tried to, like every other industrialist, he thought that yeah, he can rectify it and he can make good the company and there can be a turnover or turnaround of that particular company, but it failed. That is the time he realized that yeah, it cannot be. You can never invest into a company which is going into the so-called negative or so-called uh, headwinds. The market is going negative and the company may go bust. So that was his one of the worst decision. After that he stopped the so-called cigarette butt strategies. So later what he did is in that year 1967, after taking the majority stakehold, he had declared dividend of 10 cents on each outstanding stock. So that is the first time and last time he offered dividends to the company. And later in 1968, his own partners have seen a jump of 60 percentage, and Buffett's personal fortune crossed 100 million in assets. And in 1969, during the peak of Vietnam War, uh, yeah, see, he took a very drastic decision of liquidating the entire of partnerships. He said he did not find any better bargains in the current market because that was a time when the American market and US economy was doing very bad due to the expenditure in the Vietnam War, where they are fighting a losing cause. So with that, he had disbanded the entire company and he owned only one company, that is called Berkshire Hathaway. The rest of the partnership he disbanded. So in as I said, what are the phases? This is in nutshell about how he has transformed. And later after 1969, he has only picked up great companies which are attractively valued. May not be, the valuation may not be so low, but yes, decent value. So that is how he started picking up stocks, and that continued even till today. So now let us see what are the stages in which he has shifted his strategy. Like everybody of us, like we all have might have started with the technical charts, and like us, he also picked up something called as City Services Preferred Stock. As I said, he took it for $38. It plunged down to 27, and that is the $23. Sorry. So later it went up to 40. That is the time when he sold it. Then after some time it shoot up to $200. That's the time he realized not that he should wait, and he should not be very reckless, or the so-called he should not be sentimental while dealing with the stock market. And then next came is after this. Initially he was into it, then he was picking up all gas and real estate kind of stocks which are not doing well, and they were all into losses. Then he was trying to find out a solution for that, and that happened to be during his University of Nebraska, during graduation. He happened to have read Benjamin Graham's two books, Intelligent Investor and Security Analysis. That gave him the idea how to pick right kind of stocks, which is called as value investing. Value in the investing is based on finding out the intrinsic value of the stock, and if the intrinsic value of the stock is higher than the market price, you need to have a margin of safety which is usually one third or 33 percentage, difference. As I explained in the past, if a company value is $100 or 100 rupees by intrinsic value, then the margin of safety should be somewhere around 33% or one third. So if the price is below 67, you can purchase. Why this margin of safety is required is, even if stocks go bust or the markets go wrong, still you will book the profit and come out. So this is what the concept is all about. Then comes, as I said, about cigarette butt strategy, investing in troubled asset investment, and any company which is struggling because it's lowly priced, and assuming that they may give you windfall profits probably in future to come. The moment you get a good amount of decent profit, you quit it. This is what most of us as investors we tend to do, and even I'm also included. Initially that was my strategy, but yeah, once uh, Warren Buffett has seen a series of losses, he decided to quit that strategy, and then he slowly drifted towards, so-called Benjamin Graham, who propounded that, value investing. And as I said, within 2 3 years of close partnership with his boss, or the so-called mentor, Benjamin Graham, he realized that Benjamin Graham do not value anything, or give any value to the quality of management, which uh, Warren Buffett feel that that is one of the very important decision one has to take. And this has come only after he understanding the process of stock selection propounded by Philip Fisher, by conducting a due diligence, and market analysis in the form of scuttlebutting, which I explained in the past. So from then there was another phase, very interesting. This has transformed his way how he looked at, investing. It is American Express in 1960s. That was a time when there was a huge corporate scandal which has taken place. In 1960s, there was one Allied crude vegetable oil company. So that company, what it did is, uh, they have committed a fraud because they understood one thing very clearly. The oil being lighter, it will float. So they constructed a huge tanks, and then they used to fill it initially with water, and then over the top of it he used to fill it with oil. No, and then they used to, whenever there is somebody coming for inspection, everything, and those people within that company or the employees in the company, they used to fool it by putting the dipstick to the bottom, and you can say, uh, exaggerating the claims, and these false claims one day was got busted, and later the companies which have given around 150 million loans to this company gone bust, market crashed, and one of the company which offered maximum amount of loan is American Express. It lost 58 millions due to this fraudulent loans out of 150 million. And then everybody, what to his surprise, the American Express stock fell down from $65 to 35 overnight, which is around 50 percentage. And then what he observed is, everybody, throughout the city, there is no droppage of usage of American Express cards. Then he understood, anything happening to a great company, people who are loyal customers will not immediately switch over loyalties, still continue with it. Then he understood, yes, this price, whatever decline is, dip is just temporary. So, very, the moment he returned to his office, he took a very bold decision, putting 40% of his partnership assets, which is around $13 million, into the American Expert stock. So in 2 years, that stock prices tripled, and then the partners have gained by $20 million in profits. So this has transformed his the way he has to look at things. He started changing his investment ideology to purchasing great companies. So these are his philosophies at the later date, which I thought, let me uh, you know just read it out. One of the principles is to buy great businesses when they are having a temporary problem, or when stock market declines or creates bargain prices for outstanding franchises. So what he says is, any company whichever is a great company, whenever there is any crisis, especially in the stock market, that is the time when you have to take advantage. Instead of selling your shares, you have to purchase more and accumulate, so that later date you can take advantage of any further increase in prices. Then second philosophy is, never predict the direction of the stock market. What will it be tomorrow? What will be after 2 months, 10 months, 1 year, 10 year, 20 year? Never predict it. Prediction many times go wrong, and don't do that. Always there is, and don't waste your time and money in predicting stock market by reading or subscribing certain journals or literature which will try to predict it. So what he says is, never try to do that, whether it is election year, non-election year, whether interest rates goes up, down, economy, the condition of economy. Stop wasting trying to predict all these things. Better you just understand the dynamics of the business, understand the stock as such, and understand the pitfalls within that particular business or the company, and see where exactly it is heading towards. And always study the facts and financial condition, value of the company's future outlook, and purchase when everything is in your favor. Don't be in a hurry. The moment you find a great company, don't rush and put all your money into it. That's a poor strategy, and I would try to avoid. Then Buffett claimed that of course, it's not Buffett. It's basically, of course, yeah, yeah. What I do is not beyond anybody else's competence. What he says is, everybody is competent to do what Warren Buffett is doing. So it's not as difficult as somebody